Good afternoon. My name is Sybil Mullen, and unfortunately, my lights are on a timer and I cannot stop them from turning on. This week's assignment is, my homework assignment is completing the accounting cycle. Why is the accounting cycle necessary? The accounting cycle is a process by which companies identifies, analyzes, and records its financial and accounting details. For the purpose of a company's financial records, all transactions are actually recorded, and those transactions are documented from the moment the transaction begins to the moment it is finalized on the company's financial statements. The purpose of the accounting cycle is to generate reports known as financial statements. A business uses financial statements to analyze its performance over a fiscal period. The accounting cycle works by a series of rules meant to ensure a uniform production of financial statements that are accurate and conform to the industry standards. There are several steps in completing the accounting cycle. The 8 steps in the accounting cycle in order are transactions, journal entries, postings, trial balance, worksheet, adjusting journal entries, financial statements, and closing of the books. At the end of the accounting period, a trial balance is calculated as the 4th step in the accounting cycle. There's different steps affect the cycle in their own unique way. For instance, journal entries, it's recording the transaction, and posting is segregating the entries, while trial balance is totaling all the related accounts, and adjusting entries, basically to adjust any omitted entries, and then of course the financial statements to show the results of the entire accounting work. Basically, in accrual accounting basis, all the steps play an important role to provide the best results of an accounting cycle. In accrual basis, all the above mentioned steps are followed by each other, and every step was done in a timely manner. And if any of it's missed, well, that will lead to great confusion and problems, and you'll have to start all over again. The accounting cycle has timing and periods as well. An accounting cycle coincides to an accounting period. An accounting period is the range of time in which various accounting functions are completed. This period occurs within either a calendar or a fiscal year. Accounting periods are necessary because they provide a set period within which stakeholders in the company can determine whether the company has met their expectations or not. And it's very important in business decisions of knowing how well a company is doing at any given time. So the accounting cycle helps give those clear snapshots. So that's extremely important. So that way you know how the money is being invested, if the company is growing, if the company is losing money, and so forth. How'd you do Q1 compared to Q2? And, every company has sales goals, of course, you have profit goals. And this allows you to see, are you making those profit goals? So the accounting period most typically happens during an annual period. Regardless of whether the accounting cycle corresponds perfectly with the year or not, at the end of the cycle, all the company's transactions must be accounted for. The final financial statement that the company produces at the end of the accounting cycle just demonstrates whether the company was successful during the accounting cycle, like I explained before. So to explain it, I guess the best way to an entry level, you would explain in this, like the accounting cycle ensures that all the accounts have been debited and credited, are documented, and that the money going into the accounts and the money leaving the accounts is equal. It also makes it possible for businesses to compare the results with other businesses in their industry because there are accepted time frames for accounting purposes. The quarter and year are 2 such accepted time frames. Mid-level. An accounting cycle enables the fiscal accounting by financial accounting that the businesses need to perform to be in compliance with federal regulations and tax codes. The government requires companies of all sizes to disclose their financial results and pay taxes on their profits, which they must calculate on their own. The accounting cycle ensures accuracy and uniformity among companies, making the market fair for competition and making information available to interested parties. At the executive level, that's really the big overall picture. They already understand most of the basis of the things going on. But, for public companies, financial statements are not optional at the end of the year. These statements most often are produced in the form of an annual report. It not only demonstrates the company's success of the previous fiscal year, but also provides a picture into how the company is likely to perform the following fiscal year. These statements are critical for investors who use them to guide their decisions and investments in the following year. At the conclusion of the accounting cycle and at the end of the fiscal year, these reports are available in the investor relations sections of a company's website. For me, it was hard to find an exact ethics dilemma, but one of the things I did find was there's always pressure to manipulate the figures or, cook the books to make a company appear better than they really are. So it would be important to me to make sure that the accounting team understands that they have a clear ethical and legal obligation to report our financial situation accurately, and failing to do that can open them to civil or criminal liability and bringing their careers to an end. Thank you very much, and I do apologize for the light behind me, but it's on a timer and it's motion censored, so I don't have much control over it.